Laser fund scenarios. In this episode, I'm going to address how does a laser fund generate tax-free payouts of 8 to 10% per year for retirement income. Totally tax-free. You're going to be blown away with this concept. Pay attention and stay with me to the end. So I'm Doug Andrew. I've been a financial strategist and a retirement planning specialist now for north of 48 years, helping people optimize their assets, minimize taxes, and empower their authentic wealth. I've helped thousands of people accumulate their money tax-free in one of my favorite financial vehicles, which I call the Laser Fund. Laser is an acronym that stands for Liquid Assets Safely Earning Returns. What is a laser fund? It is a max-funded tax-advantaged insurance contract structured correctly and funded properly. An indexed universal life policy is my favorite, and I've been able to earn average returns of 9.62% over 20-year periods for the last 40 years, any 20-year period. If you round that down, 9.6 divided into the rule of 72, while your money's growing, it will double about every 7.5 years. I've had many people start out with, let's say, 500,000. That doubles to $1 million in 7.5 years. And then to 2 million in another 7.5. And then 4 million in another 7.5 years. And then to 8 million. So 30 years down the road from when they put in 500 grand, they have 8 million. And that 8 million can generate 600,000 to 800,000 a year of tax-free income for as long as they lived, based on actual history and performance, without depleting principal, based on what I'm going to share with you in this video. So basically, about every $1 million can generate 80,000 to 100,000 a year of tax-free income without depleting principal. Why is that so important? It's because the financial services industry standard is the 4% rule. Why? Because if you have $1 million in tax-deferred IRAs or 401ks invested in the market, Dalbar says if you bought and held, you'd probably earn 9.14% and net 6% after tax. But that's not what people actually do. People get emotionally involved in their money in the market. And so when the market starts to go down, 20, 25, 30%, they say enough already because this is their retirement nest egg, and they sell low. And then they wait till the market has come back strong, and then they buy high. And so the average retiree with money in IRAs or 401ks in the market is only earning 3.49%. If you're earning 3.5%, they only want you to pull out 4% because they don't want to be sued for you outliving your money. So $1 million nest egg, they only want you to pull out $40,000 a year. And you have to pay tax on that. Even in a 25% bracket, you're only netting 3. That's pretty pathetic. You subtract the 1% asset management fees on $1 million, that's another 10 grand. You're only netting 2. You can pull out 8% or 80,000, and 80,000 is 4 times 20,000. If you're netting 3%, I've earned 10 and netted 9 my entire life with Universal Life. And so 9 is 300% more than 3. 90,000 is 3 times 30,000, and it's totally tax-free. So this is the magic behind not outliving your money. So when we talk about how to create this tax-free income, in the book I want to gift you at the end, and it's a 300-page book. You don't have to pay $20 for it on Amazon. I'll gift you a copy. But in the book, we're talking about chapter 9. It talks about various scenarios of people accumulating money. And you'll see all kinds of examples at different ages. Younger ages, socking away $500 a month. You'll see older people, maybe a 50-year-old or a 45-year-old, sock away $100,000 a year for 5 years, doing strategic rollouts or repositioning money from maybe a rental property. They're sick and tired of being the landlord and fixing the toilets and taking out the trash. And maybe they have $100,000 in the bank earning next to nothing. So you reposition assets to increase the liquidity, the safety, the rate of return. And so there's examples in here talking about $100,000 a year for 5 years in compliance with TAMRA. If you don't know what that is, be sure and search on this channel for videos that explain TAMRA so that you can access the money tax-free. And you put in, $100,000 a year for 5 years, that's $500,000. And then we show illustrations of pulling out $51,000 a year tax-free from then until age 100, age 120 without depleting principal, and all kinds of other investments crash and burn. And people go, well, wait a minute, $50,000 a year, that's a 10% payout. How can you do that when maybe the insurance policy is only averaging 8%? I wish I had a nickel for every time I've been asked that question. How can they pay you 10% when you're only earning a net of 8? So I'm going to give you this example because, again, a lot of times people go, wait a minute, how can an insurance company earning 4% on their general account portfolio afford to pay you 8%, double that? Well, that's through indexing, because you're saying anytime you want, you know what, I think the market is going to be going up. I feel bullish about America. And so the 4% on your million would be only 40,000. But if you want to link to an index, you're saying, you don't have to keep that interest on hand. Use that interest on my million, that 40,000, to fund an options budget and buy upside options in the indices that I'm going to select that you choose. And so they do that, and they have the wherewithal to pay you 8% or 12% and even 25 and 61%, like many of our clients have achieved. But then if you guess wrong and the market crashes, your million is still safe. The 40,000 of interest you relinquished because it bought options which expired worthless if the market went down, but you didn't lose your million. Why do you link to an index? Is because you'll usually tweak your rate of return by 2, 3, 4 percentage points higher than the general account portfolio rate on the average, and some years much higher. And so that's one of the reasons an insurance company can afford to pay you, let's say, 8 when they're only earning 4% on their conservative investments, because they don't have to keep that interest in your account if you're saying, oh, I'll relinquish the interest on my million to give you the wherewithal to pay me whatever the market does if it goes up. But you don't owe me anything if the market crashes, but I didn't lose my million. Okay. Now, how can they afford to pay a 10% payout? This is illustrated in several different scenarios in this chapter 9 of the Laser Fund book. And you're going to see where people stocked away $12,000 a year for several years, and then they pull out $125,000 a year tax-free. And you're looking and you're going, wait a minute, I only had $1,250,000 accumulated in there at age 70, and you're giving me $125,000 a year. That's a 10% payout. How can you give me a 10% payout when you're only illustrating at 8%? You ready to find that out? It's pretty incredible when you understand this. Now, in other episodes, I talk about when you access money, you can withdraw money, and in a universal life insurance policy or any permanent life insurance policy, you can recover your basis tax-free. So if you put in, let's say, $500,000, and you start taking out $50,000 a year, it would take 10 years before you recover the $500,000 you put in. But if the $500,000 doubled to $1 million, and you start taking out $100,000 a year, a 10% payout, it'll only take 5 years and you've recovered your basis. If you keep withdrawing money after the 5th year, you now have to pay tax because you're into your gain. The IRS says, no, you don't have to do that. Change the nomenclature. Call it a loan instead of a withdrawal. Now people go, well, why would you borrow your own money? No, stay with me here. There's 2 choices when you borrow money. Now, the biggest reason why you want to borrow the equivalent of your interest is because when you borrow money, that is not deemed earned passive or portfolio income. Those are the only 3 types of income Americans pay income tax on since 1986 tax reform. Earned income is, salaries and wages. Passive income is rent and lease income. Portfolio income is interest and dividends, and most investments will be under one of those three categories, right? Well, when you borrow money for a house or for a car, you don't have to pay tax on that. You're borrowing money. So yeah, you have $1 million in the insurance company. Now, you could withdraw your interest if it's 10% or 8%. You could withdraw $80,000. But pretty soon that's dumb because you're going to have to pay tax once you've recovered your basis. If you borrow the equivalent of your interest, you're telling the insurance company, just leave my $1 million there and use it as collateral and loan me from the insurance company, loan me the equivalent of my interest. So if that's 8%, that's $80,000. They'll loan you $80,000, which is the equivalent of your interest. So now at the end of the year, you have $1,080,000 because you didn't withdraw anything. So you have at the end of the year $1,080,000. Now you have this phantom loan balance of 80. I say phantom because it's not due and payable during your lifetime. It's going to be washed away when you die. But see, you have $1,080,000 at the end of the year minus the $80,000 loan balance. That nets you the same $1 million you would have had you pulled it out the dumb way and paid tax on $80,000. By borrowing the equivalent of your interest, it's tax-free. So far, so good. Now, you keep doing that, and the loan balance keeps growing, but your cash value in the policy keeps growing. And this balance that's growing minus this loan balance equals the same $1 million you would have had you pulled it out the dumb way. And it's never due and payable during your lifetime because this minus this equals the same amount, and that blossoms and transfers tax-free. It's paid off when you die. Now, when you borrow money, there's two choices. With Indexed Universal Life, you can choose what is called the zero wash or zero cost loan. Most insurance companies will say, if you want, you can play it conservative. And so on the loan balance over here, to satisfy the IRS, they have to charge you a minimum statutory interest rate. That might be 2%. So they're charging you 2% on this loan balance on your annual statement, but they're going to credit you the same 2% or close to the same 2% on the money that's growing, that is collateralizing the interest that you didn't withdraw. They're crediting you the same 2%, and the original $1 million still earning whatever the index is, let's say 8%. But if they're charging you 2 and they're crediting you 2, that is called a zero wash. It doesn't cost you anything to borrow money, to borrow using your money as collateral. So that's called a zero cost loan, but it makes it all tax free. So far, so good. Well, how can you get 10% payouts when you're only earning 8%? You ready? There's another choice, and it's called an index loan or a participating loan. You can tell the insurance company, I feel bullish about America this year. You can change every year if you want. I want you to credit my entire balance, including all of the money that I didn't withdraw, all the interest I didn't withdraw. I want you to credit me with the index rate. Now, the index rate oftentimes is 10%, 11%, 16%, 25%, 61%. I want to earn that on all of my money, okay, not just the original $1 million, on the money as it's growing. Well, if they're going to do that, they're going to have to charge you a higher rate over here, like 4% or even 5%. People say, well, why would you do that? Because of the arbitrage, the spread. So based on actual history, if they charged you 4 or 5%, then they charge you 4 or 5, but they're going to credit you 10, 12, 15, okay, 16, 25, 61%, like in the year 2021 for many of our clients on their IUL policies. I'll give you an actual example. In 2017, I had a client borrow $1 million out of his policy because he's a real estate investor and he was tying up a multi-million-dollar apartment complex and he needed $1 million of earnest money. He borrowed at 5%, the index loan. That's 50 grand on that $1 million. That year, he got credited 25% on his whole $1 million that he technically withdrew, but he didn't withdraw. He borrowed against it. He got credited $250,000 on that $1 million, minus the $50,000 loan charge. He netted 20% or $200,000 tax-free on his million while he was actually using that million to make 3 million buying and flipping an apartment complex. This is incredible, okay? Now, on the average, he made a huge spread that year. On the average, using index loans, you will usually make at least 2 percentage points higher. Some years you won't, but on the average, we have found that you'll make about 2.5% higher return than the cost of the loan on an index loan. You take those 2 percentage points, and that gives you the ability to have a 10% payout instead of an 8% payout. Is this making sense? This is how many times we are able to, on $1 million nest egg, generate 10% payouts, $100,000 a year, tax-free, even though we're only showing an 8% crediting rate, because you're using indexed loans and you're continuing to earn whatever the interest crediting rate is over and above. And even though the average rate might be 8, you can pull out 10% and not deplete principal. This is how money works. And so this is how the laser fund can generate payouts of 8 to 10% tax-free. And this is why these scenarios just blow people away. They can't figure out the math, but it's all in there in the illustration once you understand it. So if you want to study some of these scenarios, I want to gift you a copy of this 300-page book called The Laser Fund. This is in chapter 9 of the book, but I would love for you to study the entire book. It's actually 2 books in one. This side is about 200 pages, 14 chapters, that has all the charts and graphs and explanations like I've been talking about. If you learn more by stories of how people actually have achieved this income, you can flip it over to this side, and this has 12 chapters with 62 actual client stories of how the laser fund is used not only for retirement, but college funding, working capital for business or real estate management, like the story I just told you. And you'll learn how this can be a phenomenal dream solution for many financial goals. So this is left brain, this is right brain. Here's how you claim your free copy. You simply go to laserfund.com, L-A-S-E-R fund.com, or click on the link below. You contribute a nominal amount towards the shipping and handling. You've got to have some skin in the game. I'll cover the rest of that cost, and I will pay for the book. I'll fire out a hard copy to you. And then there's options there to listen and learn, watch and learn, check out some of the online education, the webinars, and you can even talk to an IUL specialist to see how any of these concepts may apply in your particular set of circumstances and get a laser fund report, hypothetical, for you. They will not charge you for their time, okay? You will not get an invoice or a bill. This is about you and your brighter future. So start now, claim your free copy of the Laser Fund.